Hello everyone, welcome to Young Investors Network series on financial literacy, and today we are concluding our analysis on GOIL as one of the listed companies on the Ghana Stock Exchange. Our previous videos focused on the trend in terms of their revenue growth rates, their EBIT, earnings after tax. Then we came to do some ratio analysis focusing on three basic ratios: liquidity, profitability. We looked at the liquidity ratios, we looked at the profitability ratios, and then some market price ratios. Today, as I said earlier on, we are going to focus on asset utilization and some leverage ratios. We will do a bit of asset utilization ratios, especially those that I have highlighted here. They are not that much. Then we will look at the leverage ratios. So I have already done the calculations. All we have to do is to select them and then clear those that we have to do the calculations all by ourselves. And then okay, so we will use clear here, clear all. Good. Okay, so as I said earlier on, we are focusing on 5 years: 2014, 15, 16, 17, and then 18. Let's start with the asset utilization. Okay, in this case, we are going to explain how the company is able to utilize its assets in the organization to maximize revenue. All right, that is specifically for these two: total asset turnover and then the fixed asset turnover. For the inventory, receivables, and then payables turnovers, they have their own explanations, but in all, they also explains and then indicate a lot, or they mean a lot to investors. Okay, so starting with the total asset turnover. Total asset turnover simply refers to, or it is the gross revenue of the company divided by the average total assets of the company. Okay, so let's chart total asset turnover and then fixed asset turnover. The same explanation. Total asset encompass both fixed and then the fixed and then non, that's the current, and then yes, so the two of them focus on the total asset. Then fixed asset looks at the non-current asset. Okay, so investment in non-current asset and how they contribute to revenue generation, that is gross revenue. Okay, so first of all, because we need the average total assets, I think we have already estimated that. Yes, average total asset is here. Good. So all that we have to do is to proceed to take our gross revenue. So gross revenue is up there. Okay, gross revenue for 2014 divided by average total assets. So the average total assets, we did that in our previous videos. You take the previous year's total assets, that is 2013, then the current year's total assets, then you divide by 2, or using average function in Excel, you just sum the two up and it will just calculate it for you. So there we have it. So in 2014, the company has an total asset turnover of 5.81. okay, let's drag it to 2018. Okay, so that is what we have over there. Now let's look at the fixed asset turnover, also the same way, which is the gross revenue. The gross revenue divided by, so gross revenue divided by the average fixed assets. In this case, we are not going to use total asset but fixed asset, since we are dealing with average total fixed asset turnover, sorry. So we will take the average fixed asset here. Okay, there we have it. So let's see, average total asset. Okay, so gross revenue, there we have it here, D3 divided by the average total fixed assets. Great. So that's what we have there. Let's reduce it to 2 decimal places. Okay. All right. Then you drag it over there. Okay. So now let's see. Let's change the cell type here to calculations. All right. So now let's chart. Let's do a trend analysis for it and then speak on the figures to see how the company has performed in terms of their assets over the 5-year period. Okay, so let's so we will edit it like we've been doing always. So series 1 we will edit it. Series 1 total asset, so total asset turnover. Series 2 we will edit it, which is the fixed asset turnover. Fixed asset turnover. Okay, there we have it. So now we need the labels. Okay, I think it's better now. Let's rename it as our total and fixed assets turnover. All right, so let's cut it, take it to our blank sheet here and then do a proper explanation to it. We don't need this. Good. So now let's see. Let's change the formatting here and then make it too high. Good. Alright, so starting with the total asset turnover, as I have explained earlier on, you are talking of how the company is able to utilize its assets to generate revenue. So in a nutshell, or in a simple term, let me take it back. I want to use currencies to represent this. Okay, so I'll select this, then I'll change. I want it to be in a currency form, so GHCs. All right, good. Okay, so the figures here. Okay, so let's take it back. It's supposed to, so 2014. All right. Okay, I want it this way. All right, so let's edit it again. So we have the series name, first one to be turnover assets, the second to be fixed asset turnover. Okay, the labels, we need the data tables as well. Good. Let's manage with this for now. The most important thing is good. So this is a company like GOIL that is listed on the Ghana Stock Exchange. All right, so like I have explained earlier on, with the total assets, you look at how the company efficiently utilize its assets to generate revenue. In a simple term, if you can say that for every CD that a company invests in an asset, the figures that we are seeing here is the contribution of that CD to revenue. So if the company spends 1 CD on an asset in a particular year, that is 2015, that is per the total asset that we are seeing here, every CD that a company spends on an asset generates revenue of, for the total assets, we are having 5 cedis 81 pesos. So if you spend 1 cedi, that 1 cedi contribute. If you spend 1 cedi on an asset, it contributes 5 cedis 81 pesos to the company in terms of revenue or revenue wise. So let's look at 2014. For 2014, total asset turnover was 5.81, and 2015 declined to 4.83. 2016 declined further to 4.13, and in 2017 declined further to 3.69, and then appreciated a bit in 2018 to 3 cedis 69 pesos. Sorry. So it tells us that over the year the company's total asset turnover has been on a declining trend. All right. So every cedi that a company spends on an asset, that is all the assets, their performance, or they contribute these amounts to revenue in the organization. So how prudently is the company utilizing its assets? Now we go to the fixed asset component, that is a non-current asset. How they also contribute to, how the non-current asset also contribute to revenue generation. So you realize that in 2014 their fixed asset turnover ratio was 15 cedis 16 pesos, and in 2015 it declined to 15 cedis 7 pesos, 12 cedis 31 pesos in 2016, and 9 cedis 86 pesos in 2017, and further dipped to 8 cedis 74 pesos in 2018. So over the years their fixed asset turnover has been on a declining trend, of which is very, very crucial. Management must really sit down and look at it carefully, because it tells us how efficiently they are able to use their fixed asset or their non-current asset to generate revenue to the company. Okay, now like I said earlier on with the previous videos, to do a better comparison or analysis, you need to compare the figures that we have here to the industry average, or companies that are found in the same market or sector. So in this case, like I said, our next video will focus on Total, also a listed oil and gas company. We will do like we did for GOIL, and then afterwards we'll conclude with a very, very beautiful comparison. Okay, so this has been the trend of their fixed assets and then total asset turnover. Our next ratios will be focused on inventory turnover, receivables turnover, and payables turnover. We will do the days sales and inventory turnover afterwards. All right, so now let's look at what inventory turnover means. Inventory turnover simply refers to the number of times the company buy and sell in a year. Okay, so let's look at how you compute that. So inventory turnover, it's equal to your cost of sales. So the cost of sales here, also known as the COGS, or cost of goods available for. So cost of sales here divided by the average inventory. Okay, so average inventory here. All right, so average inventory. Okay, so there we have it, where average inventory, good, that is the stock. All right, these are the inventories. Now we said average inventory, meaning that we need to estimate the average inventory for the period in question. Okay, so we have average inventory here. Let's just tap this and now estimate the average inventory. So average inventory, we'll use average, like I said earlier on, it is the previous year's inventory plus the current year's inventory divided by 2. But we are using Excel function, or the average function in Excel, so we look at these two here. Good, so there we have it. So we will drag it, that's it. So let's make this to 2. Good. Now we've been able to estimate our average inventories for the years. Average inventories for the years. That is for the inventory turnover. Let's drag it to the side. Good. Now this is for the average inventory. Now let's, like I said, it explains the number of times the company buys and sells in a year. Let's look at the receivables turnover. The receivables turnover also explains, as it is also the efficiency with which the company is able to collect its receivables, that is debt owed the company, debtors. Okay, so the number of times that it takes the company to be able to get back its money out of the goods that it sold on credit. So this analysis is very, very important because it tells you how efficient you are in terms of debt collection. That is it, how your clients are able to, how your clients are able to pay up on time, or the number of days it takes you to be able to get your money back when you sell to them on credit. So because we said you sold on credit, under normal circumstances we are supposed to use a credit sales, but we don't see any credit sales in the financial statements because the gross revenue here encompass cash sales and credit sales. So it's really difficult for you to get the credit sales unless, of course, the company reports the credit sales, then you make use of it. So in here we are going to use the gross revenue all over the account receivables, that is the average account receivables. Okay, so let's go up. We have our gross revenue here divided by the average account receivables. So account receivables, that is debtors, we need the average for 2014. So it is 2013 plus 2014 divided by 2. So we have to go down there. We have already done the calculation. So average account receivables, that's it. So let's estimate our average account receivables using the average function. So let's go to 20 average account receivables. So we have account receivables. Good, there we have it. So we'll drag it to the last end. Good, so there we have it. Okay, now the last one that we will look at is the payable turnover. So just like receivables looks at the number of times it takes you to, or it takes you to receive your sales, your debts, the amount that clients owe you, or your revenue from clients. The payable turnover looks at the number of times it takes you to pay up your suppliers. So just like you are receiving, here you are paying. All right, so the same way that we did for the payables, it is the cost of sales, all over the average payable. So we look at cost of sales here all over the average payable. So average payables, let's see, average payables, that is the account payable. So we need to find the average for 2014. Okay, so let's scroll down. We've already done that as well. So let's take the average payables. So we go up, average payables. Okay, all right, so there we have it, accounts payable. Good, so you drag it, and then that's it, to 2 decimal places. So we'll drag it to the center. Good, let's drag this too. Good, so now we have these 3 important figures. I want us to chart them and then interpret them differently before we come to the days aspect of these same figures. All right, these are number of times it happens in a year, a full financial year. So let's take them. We will take the inventory turnover, we will take the receivable turnover, then we take the payable turnover. Go to charts. Okay, very close, but we will manage with it. So let's edit it. Okay, let's exhibit the data labels and then okay, edit. So series 1 is for inventory turnover, so inventory turnover. Then we have series 2, which is for series 2 is for receivable turnover, receivables turnover. Then series 3 is for payable turnover, so payable turnover. Okay, so now there we have it. The chart looks a bit clumsy now because of the figures, so let's take out the data. Let's take out the data labels rather. All right, now let's take them to blank sheet and then do our explanation. Let's drag it, format as is to good. So this is our turnover ratios, that is inventory turnover, receivables turnover, payables turnover. All right, so for the past 5 years, this has been the trend. I said inventory turnover is explained as the number of times the company buys and sells in a year. All right, so someone will say the higher the number, the higher or the more efficient the company is. All right, so in a year the company buys and sells at a very high rate or frequently. Okay, so let's look at 2014. So in 2014, the inventory turnover stood at 65.88, and in 2015 it went as high as 71.22 times. Let's do it that way. And in 2015 it fell to 69.5 times. 2017 it fell to 64.45 times, and in 2018 it increased to 76.14 times. So over the years you can see that you can't really tell whether this is high or low. The best will be for you to compare it with the industry, what its fellows or companies that trade in goods or services, like what they do. So as an oil and gas company that is also listed, the best is for you to look at the oil and gas sector, their inventory turnover ratios, and then you compare, or the average industry turnover ratios, then you compare it with that of GOIL as a company. But as you can see, if 71.22 is high enough for you, then you can tell that the company is efficient. But to you, if it is 64.45 and it is low, because it has been its lowest set for the past 5 years, so you can also tell whether the company is efficient in terms of the number of times it buys and sells in a year. Now let's look at the receivables turnover. Like I said, receivables turnover, you are looking at the number of times it takes debtors to pay up their debt. Okay, the efficiency or the effectiveness in collecting money owed by clients. All right, so how customers are able to quickly pay their debts, that is what we are looking at here. So in a year for 2014, the receivables turnover stood at 12.73 times, and in 2015 it stood at 9.74 times, and in 2016 it dipped, or it went low to 9.1 times, and then increased, it's further reduced to 8.61 times, and further reduced to 8.46 times. Now one will ask, which is best, high or low? So if it is high, then it means that clients are paying their monies on time. Okay, so you can easily get the money and then reinvest or do business. And if it is low, it tells us that clients are not paying their monies on time. All right, so it's either you are selling to clients who are not credit worthy, that is clients who will not pay up on time, or you are giving them enough grace period for them to come and pay. So if you look at the periods that we have considered, the receivables turnover ratio has been declining from 12 times to 9 times to 9 here to 8.6 and to 8.46. So it has been on a decline. So it's either the company is paying or is giving credit, goes on credit to clients who are not credit worthy, or clients are not paying the monies on time, or the company has given them ample. So in here it is a bit dicey. It depends. It may be a credit policy or a policy of the company to give them more time to pay up. You may not know, but the best is for you to compare it with the industry to get to know the average, so that you can compare whether the company is being efficient enough or inefficient. Now let's look at the payable turnover. So the payable turnover, just like the receivables, you are looking at the number of times clients come to pay in a year. Payables, you are looking at the number of times you pay, the company as GOIL, pay up its debts to suppliers. Okay, so let's look at 2014. As at 2014, it stood at 7.99 times. So they paid their clients 7.99 times. It took them years. Then in 2015, it reduced to 6.81 times. And in 2015, it reduced to 5.07 times. And in 2017, it reduced further to 4.87 times. And in 2018, it reduced further to 4.98 times. Now, a very, very interesting trend here. We said that if the receivables turnover ratio is high, it means that clients are paying on time. Good. Now, the reverse is, and that is exactly what we see. And if it is low, clients are not paying on time, and that's exactly what we're seeing here. It has been declining for the past 5 years. Now let's look at the payables turnover, what the company is also supposed to pay. Okay, the number of times in a year, it has also been declining. What does it tell us? The company is not paying up on time, or it takes a lot of time before the company is able to pay up its suppliers. You may attribute it to the company being illiquid, that is, it does not have enough cash to be able to pay up. That is one. It may also be that the company has a good relationship with their suppliers such that they do not really put pressure on them to come and pay. Okay, so that is it. If you owe someone, the person does not call you for the money, why do you have to pay? You can keep the money and invest it in something else. Get your revenue or get your profit as and when the creditor is in need of it, then you go and pay. So in here too, it is a bit dicey. You can't conclude that the company is being inefficient, but in a nutshell, you can say that the higher the number, the more efficient in terms of debt payment to its suppliers, and the lower the number, the more inefficient it is to the company that they are unable to pay up on time. Okay, so this has been the turnover ratios. This is on a yearly basis, so per year. Now let's go and do the trend for daily basis. So we are going to start again with the inventory turnover, but we will look at it from inventory turnover in terms of days. Then we look at, that is inventory turnover in terms of days. We look at receivables turnover in terms of days, and then we look at the payable turnovers in terms of days as well. These calculations are very easy. We need it in days, so all we have to do is to divide 365 by the inventory turnover. That is for inventory turnover. So we will drag it here. Okay, so there we have it. We will do same for the days receivables or receivables turnover in days. 365 divided by the receivables turnover. Okay, we will drag it here. Okay, let's make it 2 decimal places. Then the last one, which is the payables turnover, 365 divided by the payables turnover. Okay, so you drag it here. Alright, we've already explained what their mother really means, so we won't spend much time. We just want to look at it from days perspective. So let's go back, cancel, so we take the dates. So we have inventory turnover, okay, in terms of days. Then we have days in terms of receivables, and then payables. All right, so let's go. Okay, so we will take this. Like I said, we wouldn't spend much time on them. Good. And then data labels, let's rename it. Select data, then rename it series 1. That is days. Good. Series 2 is for receivables, days in receivables. Then series 3, that is payables in days. Okay, so that is it. Don't worry, it has become clumsy, but we will manage it. So we will drag it here. Okay, so this is GOIL, and let's see how it's holding up now. So every explanation we gave over there was in years. Number of this, the inventory turnover was in years, the number of times it happens in a year. Receivables, the number of times you get your money in a year. Payables, the number of times you pay in a year. Over here we are going to look at it from days perspective. You can also do it in monthly perspective by dividing it by dividing the number of months. So 12 months by the inventory turnover. That is if you want it in months. If you want it in weeks, you divide the number of weeks in a year by the inventory turnover. If you want it in quarterly basis, the same way we divide it. Okay, so let's start with the days sales in, so inventory turnover in terms of days. So like we said, inventory turnover, you are looking at the number of times the company buy and sell in a year. So here we are going to explain it in the context of days. So in here in 2014 we have 5.54, that is days sales in inventory, or inventory turnover in days. So it tells us that the company bought, and so it took them an average of 5.54 days, or an average of 6 days in 2014 to buy and sell. Are we okay? So to go and buy the raw materials, transform them, and then sell. That is for 2014, an average of 6.54 or 6 days. In 2015 it's declined to 5 days average. In 2016 it went up to 5.26 average days, and in 2017 it went up again to an average of 6 days. 2014 it declined to an average of 4.79 days. So what we saw over there in terms of the full year or the financial year wasn't so different, or it's not so different from what we are seeing here. Let's look at the receivables in days. Okay, receivables turnover in days. So in 2014 it took them an average of 28.68, that is 29 days to receive their debts from debtors. Okay, that is for the receivables turnover. So an average of 29 days. And in 2015 it increased to 39 days. 2016 it increased to 40 days, and in 2017 it increased to 42 days, and in 2018 it increased further to 43 days. So like we said over there, receivables turnover has been declining, meaning that clients are not paying up on time. So it is either the company is not being efficient with its debt collection, or the company is giving up goods on credit to customers who are not worthy enough. Okay, customers who are not worthy enough in terms of their repayment or credit worthy. Okay, and that is what we are seeing here, because in 2014 the average was 29 days, and it has been increasing to 37, 40 days, 42 days, and 43 days. It's been increasing. So we can go back to see or to look at their current assets, their current liabilities over there, and their current assets, and what we are seeing here with the receivables and payables, it's a true reflection of exactly what we are seeing here. It is not so different. Now let's look at their payables, what the company is paying, the number of times it takes them to pay up their debts. So in 2014 it took them an average of 46 days to pay up. In 2015 an average of 54 days, and in 2016 it increased to an average of 72 days, 75 days, and 73 days. So like we're seeing here, it's been what? Appreciating, or it's been increasing. It was only 2017 and 18 that it was stagnant a bit, or it declined just about some days, 2 or 3 days. It tells us that the company, one, may be illiquid, two, the company has a good relationship with the suppliers, or suppliers have given the company ample time in terms of their credit repayments. Okay, you can't really conclude without getting the fact, but I have reviewed the financials, and it's not only me, we have done it together. We looked at their current ratios, we looked at their cash and cash balances at the end of the period, and now with what we are seeing here, it is a true reflection of what we saw, that the company is illiquid, or the company does not have enough cash in its coffers to be able to pay up its clients. Because if you see from 45 days up to 73 days, it takes you a long time. All right, and when it happens like that, creditors will start giving you pressure. You may decide to sell up your assets, some of your assets, to be able to pay them, or when you go back for goods on credit, they are either going to give it to you at a premium, meaning you pay more, or they will decline to give goods on credit to you. So these are some of the situations or some of the analysis that you can do with respect to the turnovers. I hope you are okay with it and you understand it very well. You can read more online, get to understand how all these ratios work. Okay, that is it for the asset utilization and then turnover ratios. Okay, now our focus will be on leverage ratios. Leverage, we will look at interest coverage, debt, total debt ratio, and debt to equity ratio. We will look at these three. When you say leverage, leverage simply means debt. Okay, so in terms of borrowings, how much is it in the organization? All right, so let's do a simple one. So let's start with times interest coverage, or times interest earned, or interest coverage. So the interest coverage simply refers to, or it is telling us the number of times a company can pay up its finance cost. When I say finance cost, I mean interest on debt. When I say interest on debt, it can simply be the borrowings that the company has gone in for. So in here we have net finance expenses over here. Okay, net finance expenses over here. So it can be that the company has gone in for short-term loans, okay, from a bank or any company, and they are supposed to pay interest on them. So we want to look at how much or how many times, okay, or the number of times their earnings before interest and tax, okay, earnings before interest and tax can cover this finance cost. Okay, so to do that we will simply take our, that is times interest earned for 2014. We will take our earnings before interest and tax for 2014 and divide it by our finance cost. Okay, so let's go up. Okay, so we have times interest and EBIT. Where is it? Okay, so we have our EBIT here. Then we have our finance cost here. Good. All right, so let's drag it. Okay, so let's make it to 2 decimal places. Okay, so there we have it. Calculation. Good. So like we see here, I want us to finish with all the times all the leverage ratios, and then we will chart them together. So you look at total debt ratio. Total debt ratio simply refers to the total assets and total debts in the organization. All right, so you want to know how much the company spends in terms of debts, or how much the company spend on assets, and how much that amount make up debt. All right, so debt to total debt ratio. Yes, total debt ratio. Okay, so let's look out for we need our total debt and we need our total assets. So total debt, why is total debt? Okay, let's come down to total debt. Okay, so we have our total debt here. Okay, let's see. Total debt here. Okay, total debt. All over total assets. All over total assets. Good. So now let's see. Good. Let's make this to 2 decimal place and then make it kind of city. Okay, good. All right, and then debt to equity. For debt to equity, you are looking at the total debt all over total equity. All right, I'll do the explanation as well. So total debt all over the total equity. Total debt all over total equity. Okay, so there we have it as well. Okay, so 2 decimal places. Okay, and then we make it cities. Okay, gonna cities. Okay, now let's take the times interest earned first. So we will select the times interest earned. Okay, let's finish with the total debt and total equity, since the two here. Good. And let's rename it. So we have good data. Let's edit it. Select data. So we have total debt ratio. Then we have debt to equity ratio. Okay, so there we have it. Let's take it to our blank sheet. Okay, good. This is GOIL. Now let's see total debt ratio. Now, like I said, the total debt ratio, you are looking at your total debt and your total asset, or debt to assets ratio. That is what some people call it. So it simply refers to the amount of money that you spend in the company, how much of it is coming from borrowings, and what is its contribution in the company. Okay, so let's say in 2014 their total debt ratio stood at 77 pesos, meaning that for every 1 cedi that they spent on an asset in the company, 77 pesos of it was borrowed or was from debt. And then the difference, which is the 23 or 33, that is 23, sorry, comes from equity. All right, so in 2015 the same way it's increased to, okay, it is here. So in 2014 it was 77 pesos, and in 2015 it increased to 82 pesos. 2016 it decreased to 64 pesos. It increased to 66 pesos in 2017 and 68 pesos in 2018. So we can say that the company is highly leveraged. I am being careful here because to say that the company is highly leveraged, you mean that the company is financed mainly through debt or borrowings. I am saying this because if you look at the total debt ratios that we are seeing here, more than half of it, of every investment that is made in the company, is through debt, or the company is financed through debt. For 2014, for every 1 cedi that the company spent on an asset, 77 pesos of that 1 cedi was from borrowing. 2015, 82 pesos of it. In 2016, 64 pesos of it. 17, 66, and 18, 68. So it was in 15 and 14 that was very high, but still in 2016, 17, and 18, 60 pesos or more than 60 pesos of every 1 cedi they spent on the company is from debt, or is from borrowings. Now let's look at the debt to equity. So the debt to equity refers to the ability of shareholders to cover up all outstanding debt in the company. So for every 1 cedi, or for every cedi that they spend on the, or for every cedi that they spend in the company, how much of it is generated. Okay, so we have total debt to equity in 2014 stood at 3 cedis 43 pesos. It increased to 4 cedis 57 pesos. In 2016 it declined to 1 cedi 77 pesos. In 2017, it declined, or it increased to 1 cedi 95 pesos, as we're seeing here. And in 2018, it increased to 2 cedis 15 pesos. So how is shareholders' ability, or the shareholders' equity, able to cover all outstanding debts? So for every 1 cedi in debt, how many times can shareholders' equity cover that amount of debt? That is 3 cedis. So if the company is spending 1 cedi or from debt, or is borrowing 1 cedi, the shareholders' equity can pay up that amount 3 times, or 3.43 Ghana cedis, 4.57 cedis, 1.77, 1.95, 2.15 for the period. So this has been the performance of GOIL. We have been able to do a lot of analysis on the company. We started with the growth rates in terms of their revenue, EBIT, earnings after tax, dividend per share, earnings per share, cash and cash equivalent, dividend paid, a whole lot of them. We have done a lot of analysis on GOIL as a listed company. There are a lot of ratios that we did not cover as well. Some of the unhighlighted ones that you see here, we did not cover them, but you can do them at home. And then there are a lot of ratios that we haven't even covered at all. You can also do some analysis on them. Now you know how this whole thing is done, so you can easily do it at home. The best and the most interesting part of this whole thing is for you to be able to understand what these figures mean, how you can take advantage of some of these figures to invest in some of these listed companies. Okay, we are not doing this just because we want to do it. We are doing this to educate the public, to educate investors. These are not professional explanations. They are just basic explanations that you can use in your daily investment decision making. Like I said, our next assignment is going to be focused on Total Ghana. As you can see here, it has already been prepared. We will look at it as well. Just like we did for GOIL, we will do same for Total, and afterwards we will do who is who for the two companies. This has been Prosper from UMB, Young Investors Network. I hope you enjoyed this presentation. Please like our page, subscribe, and share. If you have any comments, don't hesitate. Thank you.